Hey guys, so this video is going to be a breakdown of 5 of the best performing, most reliable, and low-cost ETFs available from Vanguard. We'll go over why index fund investing is the best way to achieve long-term wealth and how you can get started investing today. Some of these ETFs are definitely on the riskier side but offer high potential growth, and some are a bit safer but still offer excellent returns. If you take a look at Vanguard's website, you can see a comprehensive list of all the ETFs they offer. So if you scroll down this list, you can see that there are US bond ETFs, there are all the US ETFs in large cap, medium cap, and small cap companies. There's international bond ETFs, international stock ETFs, and sector and specialty ETFs. However, from this long list, I do think there are 5 particular ETFs that will make you a ton of money in the long run. They've all done well historically, and I do think that they will have great future performance. I highly encourage any investor at any level to make these ETFs a significant portion of their stock portfolio. The first one we're going over is the fan favorite, and this is VOO, Vanguard's S&P 500 ETF. Just as the name implies, this is an ETF that tracks the S&P 500. Pretty much anyone that invests in ETFs or index funds is likely going to have VOO or some other fund from another company that tracks the same index. The reason why it's so popular is because it's basically like investing in the top 500 companies in the US. So let's take a look at Vanguard's own website to see what this ETF is all about. Right now, this ETF is trading at $307.07. If we look at the product summary, you can see, yes, this invests in stocks that are in the S&P 500 index, and the goal is to really just mimic this index, which when done right, seems to produce really good results. A fund like this is a little bit more risky, so Vanguard has rated this as a 4 out of 5 on the risk scale. The reason for this is because VOO only invests in these 500 large companies, and they don't have any types of bonds in their portfolio. So yes, the risk is a little bit higher, but the potential for growth is definitely much higher. Let's take a look at their performance, and you'll see why everyone loves this ETF. So their quarter end average annual returns for the last year show that this fund has hit 7.45% growth, and that is just under the S&P 500 index of 7.51%. Their 3-year average annual returns is 10.69%, and their 5-year annual returns is 10.69%. And since its inception in September of 2010, this fund has had an average annual return of 13.52%. Now, anyone that invests in stocks knows that this is an amazing return. The stock market definitely has been quite strong in the last few years, so there's no guarantee that this growth will continue, but we'll see. On the right side of this page, you can see the hypothetical growth if you invested $10,000. And yeah, it's just a very good line going up, and that is what you want when you invest. Now, looking at the portfolio composition of VOO, you can see that a large majority of the companies that are in this fund are in information technology. There's also a significant amount in healthcare, in consumer discretionary, and also in communication services. And some of the largest holdings in this fund are Apple, Microsoft, Amazon, Alphabet, Facebook, Johnson & Johnson, and more. Since this is the S&P 500, this is going to be a blend of large cap companies. VOO currently has 509 different stocks in it with a median market cap of $143.8 billion. The average price to earnings ratio is 25.7, and the average price to book ratio is 3.5. The average return on equity is also 19.6%, which is very good. And yeah, probably the best part about this fund is not only how well it tracks the S&P 500 index, but also its extremely low expense ratio. Anytime you're looking at an index fund ETF, you want to make sure that the expense ratio is as low as possible. And in this case, it's 0.03%. What this means is that for every $1,000 you have invested in VOO, Vanguard's taking 30 cents per year. That, you guys, is basically nothing, and that's why this is such a great fund to invest in. Now, VOO is an ETF, but if you want to invest in a mutual fund, Vanguard also has VTSAX, which is their basically mutual fund version of the stock. Technically is a different fund, but they have had very similar performance throughout the last years. The main difference is that VTSAX is a mutual fund, and there's an initial minimum investment of $3,000. And it also has a higher expense ratio of 0.04%. Now, a majority of what I own in stocks is actually in VOO. It's just the standard that most people seem to invest in because it has great growth, but also very great reliability. So if you're just looking for one ETF that is a bit on the riskier side, but has done extremely well historically, VOO could definitely be that ETF for you. All right, the second ETF we are going over today is VOOG, which is Vanguard's S&P 500 Growth ETF. This one's a bit different than VOO. I know it sounds very similar, but VOOG has more focus on these growth stocks, whereas VOO is more a blend of growth and value stocks. A lot of the companies in this ETF are definitely riskier, but they do have that potential for high reward. Many of them have very high PE ratios, which means that investors just expect their earnings to grow significantly throughout the next few years. So probably not the best fund for anyone that is a super value investor who cares really about the fundamentals and earnings of a stock. And yeah, you'll see that there are tons of technology stocks in this ETF. So Vanguard's own website says that VOOG invests in stocks in the S&P 500 Growth Index, which is composed of the growth companies in the S&P 500. They rate this ETF as a 4 out of 5 on their risk scale. And right now, this ETF is trading at $205.55. So it is a bit of an easier buy than VOO. Just like the product summary says, VOOG has a really high potential for investment growth, and it's probably one of the best ETFs to get if you really care about the percentage of growth per year. Let's take a look at the performance, more specifically the average annual returns for the last decade. In the last year, this ETF has done extremely well, and they've hit 17.63% growth. In the last 3 years, they've hit 16.59% growth, and over the last 5 years, their average growth is 14.47%. And since its inception in September of 2010, this fund has grown by 16.03% on average per year. Portfolio-wise, very similar to VOO. You can see that a majority of the companies in this fund are in information technology, as well as consumer discretionary and communication services. There's also a lot in healthcare. The fund is definitely less diverse than VOO, so that is why I do think it is a bit more risky, because right now they only have 279 different stocks in this fund. And since it is market cap weighted, you can see that the top 10 holdings in this fund make up 45.3% of the whole thing. So yeah, same thing as VOO, companies like Apple, Microsoft, Amazon, and Alphabet. So definitely large companies in this fund, but it is not really a blend of value and growth. It's mostly just growth companies. VOOG's median market cap is $213.3 billion, and its price to earnings ratio average is 32.8, which is much higher than VOO. It also has a very high price to book ratio average of 7.3. One good thing is that their return on equity is very good. It's sitting at 23.5%. I'd say that the one big downside about this fund is that its expense ratio is quite a bit higher than VOO. In fact, this one is over 3 times higher. Now, don't get scared away by that. I mean, VOO's expense ratio is just super low at 0.03%, and this one's sitting at 0.1%. That means that for every $1,000 invested in VOOG, Vanguard is going to take $1 as their fee per year. If you want to be more risky and you want to invest in more of these hype stocks and don't really care about those value stocks, then VOOG could definitely be the right ETF for you. I normally say that the younger you are, the more you're able to actually invest in these high risk ETFs, because these riskier ETFs, they tend to go up and down and up and down. So if you're more towards retirement, that's when I'd go something a little bit more safe. But if you're young and you're investing in these, you won't be taking your money out for a long time. Just don't freak out when the price drops a lot and sell. That's not what you want to do. You just want to hold on to these for as long as you can. All right, the third ETF on my list is VNQ, and this is Vanguard's real estate ETF. VNQ is mostly comprised of commercial, specialized, and residential real estate investment trusts. If you want a more diversified way of being able to invest in real estate companies, then this is absolutely a great option for you. So taking a look at the Vanguard page, you can see that VNQ basically invests in companies that purchase office buildings, hotels, and other real property. This ETF tracks the MSCI US Investable Market Real Estate 2550 Index. And it definitely is a bit more on the riskier side, so Vanguard rates this as a 4 out of 5. This is a cheaper one on this list, and right now they are trading for $80.20. Obviously, real estate has been hit pretty hard, so if you look at the performance for this fund, you'll see that, in the last year, it's actually done extremely bad. But also that offers more opportunity for upside in case real estate does get a lot better. I do think real estate is gonna get a lot better, especially in the long term, so you don't want to invest in this right now because, it probably won't increase by much. But in the long term, real estate will get back on its feet, and this should make you guys a sizable return on your money. So yeah, looking at the chart, you can see that in the last year, this fund has returned negative 6.98%. The farther out we go, though, you can see that the performance gets better and better and better. So at the 10-year mark, this fund has actually returned an average of 9.7%. And since this ETF was started in September of 2004, it's grown by 7.72% on average per year. So yeah, looking at the price chart, you can see that there was that huge decline during the pandemic, but since then it's started to slowly recover. Like I mentioned before, the portfolio composition of this ETF is mostly specialized REITs, industrial REITs, residential REITs, office REITs, industrial REITs, and healthcare REITs. VNQ currently has 181 different stocks in their fund with a median market cap of $19.1 billion. The price to earnings ratio is quite high at 33.1, and the average price to book ratio is 2.3. The return on equity right now is not too hot. It's sitting at 6.1%. And another important thing to know about VNQ is that its expense ratio is 0.12%. This is quite a bit higher than VOO, but it's still very good for a real estate ETF. You'll find that the more specialized the ETF, normally the expense ratio gets higher. VNQ is great for long-term investors that want to invest in an income-producing asset. If you currently don't invest in any REITs, then this might be a good way to get your feet wet and start investing in real estate. And especially if you have a positive outlook on real estate in the long term, then this could be a great fund for you. All right, next up on my list is VIOO, which is Vanguard's S&P 500 Small Cap 600 ETF. This is definitely one of Vanguard's best small cap ETFs that tracks this particular index. This is definitely more risky, and it's because small cap companies tend to see bigger swings than large cap companies. However, with that higher risk comes higher potential reward. Right now, VIOO is trading for $130.06. And like I mentioned, the risk is quite high, so Vanguard rates this as a 5 out of 5 on the risk scale. Looking at the performance of this ETF, you can see that, small cap companies have not been doing so well recently. The quarter end average annual returns for the last year for this fund are not very good at all. They are at negative 11.17%. But overall, since its inception in 2010, this fund has actually performed quite well with an average annual return of 11.05%. So that's what I mean when I say this one is definitely more risky. You're going to see these huge jumps, but in the long term, this fund performs very well. The companies in this ETF are definitely a little bit more spread out than some of the other ones we've been talking about. For example, this one has a good blend of consumer discretionary, financials, healthcare, industrials, and infotech. There are currently 606 different stocks in this ETF with a median market cap of $1.7 billion. The average price to earnings ratio is 18.7 and the average price to book ratio is 1.6. The return on equity is mild at 9.5%. And regarding its expense ratio, this one is quite low at 0.1%. So I will say that this fund is probably one of the best for people that have a lot of risk tolerance and who are quite young, because like I said before, if you're older, you don't want to invest in such a risky ETF. But yeah, overall, this is a great low cost ETF if you want to invest in smaller cap companies. All right, number 5 on my list is VTI, which is Vanguard's total stock market ETF, which invests in a blend of large, mid, and small cap companies in the US. And the index that this fund tracks is the CRSP US Total Market Index. This is by far the most diversified fund on this list. It has way more companies than all the other ones combined. So right now, VTI is trading at $169.13. Vanguard also rates this one as a 4 out of 5, but I definitely think that this one is a bit less risky than the S&P 500 ETFs that we've talked about. Its performance is quite strong, and you can see that in the last year, its average annual returns is 6.44%. Looking at its 3-year average annual returns, we can see that's 10.04%, and its 5-year is 10.02%. Its 10-year is actually very, very good at 13.73%. But if you zoom out to since its inception in 2001, you can see that it's only at 7.21%, and that's largely due to the dot-com bubble. But yeah, overall, very solid growth. This one also has a healthy blend of different types of companies. We can see that it's heavy in consumer goods, consumer services, financials, healthcare, industrials, and technology. Now, like I mentioned before, this ETF is absolutely gigantic. They currently have 3,529 different companies in this fund. And that's really what makes it a little bit more safe than something like VOO. The median market cap for this ETF is $104.1 billion with an average price to earnings ratio of 25.3. The average price to book ratio is 3.3 and the average return on equity is 17.6%. One really great reason why a lot of people love this ETF is because of the extremely low expense ratio. With the expense ratio at 0.03%, this is much lower than many of the other ETFs that track this index. And in the long term, that low expense ratio is going to save you so much money. So yeah, you guys, these Vanguard funds offer you a low cost solution to investing passively. You literally don't have to do any research about any companies, and you can just buy these ETFs and watch them grow in the long term. You're basically just investing in the market as a whole, so it is much, much safer than picking your own individual stock picks. In fact, Warren Buffett says that this is the best way to invest for almost every single person out there. there. It's a long-term wealth building strategy that has made so many people into millionaires. And the earlier you start, the more you take advantage of that compound growth, and the faster you will become a guaranteed millionaire. And even though some of the ETFs on this list are a bit risky, they are still much safer than picking your own companies to invest in. So now, where can you buy these ETFs? Well, you can buy them on Vanguard, but you can also buy them on any stock trading platform. So if you guys want to sign up for Webull and get one free stock worth up to $1,600 when you deposit $100 or more, definitely check that out. This is a great trading platform. I use it myself, and yeah, you get some free money for signing up. So who doesn't love that? I hope you guys found this video helpful, and before investing in any stock, make sure to do your own due diligence and just sort of take this video as a starting place on doing your own further research. If you guys liked the video, make sure to hit that like button and also subscribe to my channel for more videos just like this. I make a ton of content about investing, personal finance, and entrepreneurship. So yeah, that's it for today. Thank you guys so much, and I'll see you in the next video. Peace.